Hello, welcome everybody to the second session of day one of the Modern Investor Summit 2024. I'm Carl Hazley, VP of Content here at Economist, and today we are diving into a critical topic, how to adapt your portfolio for the year ahead. Now, joining me are three distinguished speakers who will bring a wealth of knowledge, experience, and insight to the table. Anthony Crudele is a seasoned trader and host at NinjaTrader. We'll also be joined by Erik Norland, Chief Economist at CME Group, and Jacob Erichsen, who is Senior Sales Trader at Saxo Bank. Together, they'll unpack macro trends that we'll dive into, including inflation, economic growth, the events that will shape 2025 markets. We'll also discuss strategies for diversifying beyond traditional stock and bond portfolios and uncover how to capitalize on trading opportunities across the financial landscape. Now, before we dive in, a little bit of housekeeping. Please use the chat to introduce yourself to the rest of the Economizers. Let us know where in the world you are tuned in from this afternoon, this morning, potentially even this evening. In terms of the setup for this session, this is a 30-minute conversation, but I'm keen to bring in as many questions as possible. So please leave your questions in the chat. I will pull out some important questions as I see them, and we will weave them into the conversation and add any extras at the end. And a big, big thank you to our sponsor, CME Group, for supporting this session. Without their partnership, none of this would be possible. So without further ado, let's get into our conversation. I guess the big question for the year ahead is, frankly, how do you see economic growth, inflation, and central bank interest rates evolving in 2025? And, the knock-on impact of those decisions, those growth trajectories on major asset classes. Erik, as the economist, I'd love to start with you and get your thoughts there first.
Yeah, sure. So, we are starting 2025 in an incredibly interesting position. So, central banks over the last few years did their biggest tightening cycle since 1981. The Federal Reserve, for example, in the United States, raised interest rates by 525 basis points. Now all these central banks have started to cut rates, but there's a lot of uncertainty. A few weeks ago, the markets thought we were in for pretty deep interest rate cuts. Now the markets are having second thoughts, in part because in many countries, including the United States and in Western Europe, inflation rates are persistently higher than where they were pre-pandemic. So for example, in the US, core inflation is at 3.3%. That's a full 1.5% above the Fed's target and above where it was before the pandemic. In the Eurozone, 2.7% core inflation, which is 0.7% higher than their central bank's inflation target. In addition to that, you have governments running astonishingly large budget deficits, 7% of GDP in the US, 5.5% of GDP in France, where the government is getting ready to collapse because they can't agree on what to do about it. Large budget deficits here in the United Kingdom, in China, Japan, Spain, Italy, many other countries. So there's just a tremendous amount of uncertainty as we go into next year, because in general, economies are starting to slow, which would argue for rate cuts. But at the same time, inflation remains persistent in many countries, and that is giving the central banks pause. So it's an environment of enormous uncertainty.
Absolutely. And Erik, maybe sticking with you for a second, maybe it's worth getting maybe your base case around the US in particular, because obviously with an incoming change of president, there are a lot of things that we're unsure about, but how are you thinking about the risks to growth and inflation that may come to pass next year?
Yes, the Federal Reserve, when it moves interest rate policy, typically those interest rate policy changes are felt with a lag of about 2 years on the economy. So the Fed only finished hiking rates in the middle of 2023. They didn't even start cutting rates until September, and their interest rates are still pretty high. So I think there's a lot of risk of economic downturn in the US. We've seen soaring default rates on auto loans, on all sorts of consumer loans like credit card debt. I think small businesses in the United States are really struggling, in part because they're much more quickly impacted by higher interest rates than our large corporations. So I think that there's a real risk of economic downturn in the US. At the same time, I think there's a lot of structural reasons to fear that inflation might not come down, and it could potentially be exacerbated by new tariffs. So there's a lot of uncertainty here.
Absolutely. I think the point you made on loans and defaults is one that's really interesting. It's something we're watching. The Federal Bank of New York just came out not too long ago showing an all-time high in loan applications being rejected, just as one data point. But Anthony, coming to you, maybe, I guess the first part of the question: do you agree with Erik's assessment? Is that the backdrop you're expecting for 2025? And how are you thinking about how to play the major asset classes against that backdrop?
So first off, I should just clarify, I'm more of a shorter term to medium term. So I'm more on the trader side than the investment side. So when I look at what the macro picture is, I look at it as just a theme, and then I'll use technicals to help guide me. And I think that I agreed a lot with what Erik said. I guess the one thing that I'm not sure about is Erik said that rates are still relatively a little high, and I guess that the market will tell us if they really believe that going forward or not. But I think that when I look into next year, because I think there's so much uncertainty with how President Trump will handle inflation and what will happen, what the Fed will do. Will they feel pressure? I think that it's very difficult to gauge at this point. I think it's really just up in the air. The way that I look at it is, if inflation does stay pretty sticky, stay pretty hot, we've already seen what that looks like. I mean, tech stocks rally, Russell struggles, and probably short the long end of the bond market because it's probably mispriced. I mean, going back to what Erik said, that everyone was looking for a lot of rate cuts to be coming in the future, and then right after the rate cut had happened, bond markets have done nothing, but rates have gone higher. Bond markets were going down, and I probably see that as a continued theme in the next year. So I like shorting the long end of the curve, and I think that if rates again stay relatively elevated, according to what Erik is saying, that rates are a little bit high, I think that the Russell will probably struggle, and you probably want to buy the dips in the big tech stocks because they're not going to be as impacted by it.
Absolutely, that's super clear. Appreciate the clarification. I guess when you think about, and you've touched on this a little bit there, Anthony, when you think about potential upside and downside risks, and appreciate your shorter term lens, where do you think, as far out as you are willing to look, people might be underappreciating opportunities both on the upside and the downside? And when you are trading, how do you think about sort of trying to mitigate those risks?
Well, right now, I think that the two areas where I see that there could be opportunity, and they kind of are contradictory to each other. First is, I'm long in my short to medium term account. I'm trading a lot of Russell. So I'm trying to buy Russell on the dips. And so I'll use futures or even ETFs. Sorry, Erik, I will use some ETFs. I know we're very futures based, but no, I'll focus more on the Russell right now, because I don't think that the Fed is going to be raising rates next year. I mean, I highly doubt that happens, right? And so even if they cut once, let's just say we're still in a rate cutting environment, and I would expect that to give a little bit of a lift in the Russell, and the small caps have been underperforming. And so I think that there's opportunity there to the upside. I mean, and when I just look at what the S&P and NASDAQ have done, I mean, their upside is probably limited compared to what the Russell may do. And I also think that shorting the long end, shorting 30-year bonds, I think that, selling rallies there is also the risk that, we have inflation remains hot, which is, I think, also, a very strong possibility. So you could have a situation where the Fed maybe only cuts once or twice. And I mean, who knows? I don't even go off of the dot plots anymore because they've changed so much. It's like, even if you look at the Fed, CME Fed Watch tool, it's predicting it's looking what the market's predicting going outward. And that's been changing so much because I think that no one really has a strong hand of to what's going to happen there. And so I think the surprises could be less rate cuts, inflation's hot, short long end, or it kind of stays in a kind of a perfect world where maybe, just maybe, the Fed cuts more than once or twice. And I think that would give a lift to the Russell, and I think it would probably outperform next year, maybe NASDAQ and S&P.
Super interesting. Thanks very much. Now, for everybody watching and listening, I'm going to give you all a bit of a shortcut here, because when you ask an economist what they think about the year ahead or the next few years ahead, you could ask, as I did, Erik what he thinks and why, or you can shortcut all of that with the next question I'm about to ask, which is, given gold's status as a hedge against economic uncertainty, you can get a sense of what an economist thinks about the broader macro picture by their view on gold. So, Erik, gold's had a strong 2024. Do you expect that to continue into 2025, or do you think gold's price might face headwinds?
So, what I think is really interesting about this, if you look back over the last 3 years, the S&P measuring from the end of 2021 is up 26%. Gold is up 48%. So gold has had a really spectacular return, not just this year, but for several years, and it's doing well, I think, in part because other countries are running enormous budget deficits. So the United States is running a huge budget deficit. We have gigantic budget deficits in so many other countries, and now the central banks are cutting rates. So I think gold's future in 2025 depends crucially on whether or not we have an economic downturn. If we have an economic downturn, even if inflation is still above target, the central banks may feel forced to cut interest rates. So if they feel forced to cut interest rates further, that makes holding fiat currency, government issued currency like the US dollar, the euro, etc., less attractive. And it makes holding gold more attractive. On the other hand, if we avoid a recession and interest rates kind of stay where they are, or maybe even start backing up again at the short end of the yield curve, meaning like Fed funds, for example, that could be bearish for gold. But my sort of base case scenario is still pretty bullish for the yellow metal.
Yeah. And I guess in trying to understand, maybe this is a great time to bring in a question from Jamie, actually, who asks, where do you see the higher chance of an economic downturn in the short term? Is that the US or Europe? So maybe you could bring in your answer to that question, Erik. And I wonder whether it's also worth explaining, the relative relationship between gold and the US economy versus Europe, because my suspicion is a downturn in Europe may not have as much of an impact on gold as if in the US. But over to you on that.
Yeah, that's right. So the thing about the U.S. dollar is that it's the currency in which almost every commodity is priced. So what happens in the U.S. is of paramount importance. Now, the U.S. economy has actually been a lot stronger than most other economies have over the last 2 years, and I think in part that's because the U.S. spent way more money on COVID relief than other countries, and then topped it off with the Inflation Reduction Act and the CHIPS and Science Act, which, in addition to spending almost $6 trillion on COVID, spent an additional $1.3 trillion on various sorts of infrastructure, ranging from traditional infrastructure to EV recharging stations, to bringing chip manufacturers out of Taiwan and back into the United States. And so all of this has really boosted growth, but now we're in a situation where some of that spending might get slashed. We're running huge deficits. The incoming administration wants to find opportunities to cut government spending. But you have to remember, government spending is a component of GDP. And when the government spends money, that goes into somebody's pocket, and they go out and spend it themselves or invest it. So when you cut government spending, sometimes you can see negative effects in the short term. Now, in the long term, maybe that's the best thing. I don't know. It's not an argument we have time for here. But in the short term, that could depress GDP growth, which could put downward pressure on rates and could potentially send gold higher.
That's really helpful. I think fabulous context for getting into that debate. I maybe want to switch to another commodity, oil. And given the supply-demand dynamics, the geopolitical considerations, Anthony, maybe coming to you, do you think do you think oil rather might break out of its range that it's been bound in for a lot of this year? And how are you thinking about oil? How are you playing oil at the moment?
I want to just say one quick thing about gold. Following
sure.
up, I agree with everything what Erik said. The one thing I would caution is that if we do see an economic downturn, look how much gold has been correlated with stocks. Go back to 2008. I remember when I was buying gold to hedge against my portfolio, and it didn't turn out so well. So I always look at gold and say, yeah, I understand the macro reasons behind them and why they should do certain things. But then when all of a sudden, suddenly the markets start to come down quickly, I think that brings almost everything down. Just because we've seen everything go up, I think we could see a scenario where everything goes down. So from a macro perspective, I'm 100% aligned with Erik. I agree with everything he said. And I just look at it from a perspective of, I don't know that necessarily gold will be a great hedge in an economic downturn. We'll see though. Oil, oil to me is one of those things. I mean, I guess everybody would think that with Trump coming into presidency again, that it's going to drive the price of oil down. It has not done that yet. Even when I look out and I just don't see really any of the macro experts calling for oil to go much lower. From what I read, and I'm not a huge oil person, especially over the last year, because it's really done nothing in terms of what it's done in the market. All you hear is, supply is pretty steady. And I've been seeing some headlines come up right now with Iran and Iraq that I think could cause some issues in the price of oil. But overall, 60 to 80 in oil has just been what it's been in. I mean, at this point, we have to see who Trump puts in for energy secretary. I know they have to get approved, and we'll see what happens, because I don't think right now it's one of those things where it's a market that's going to go back and forth. And if it breaks the door above 80, or if it breaks the door below 60, it could open it up to more, or you could see another year of just 60 to 80. I really would not. There's nothing I would play in oil right now that gives me, I would think, an edge one way or the other.
That's a really interesting setup, especially considering Chaitanya's question, who asks for your opinions on the green energy sector, considering the US, or I guess the incoming US government's mooted stance on green energy and how that might affect oil. And I suspect, not to answer the question ahead of you, I suspect it's entirely to your point, Anthony, around, if we do see oil above 80, perhaps the relative price or the relative cost of green energy becomes a factor, certainly above $90, but maybe that's very much TBC, because we don't know who the energy secretary will be. Erik, how big an impact do you think oil will have on the macro outlook, depending on what the Trump regime decides to do there?
Yeah, so I think there's a number of interesting things happening in the oil market, to sort of build on what Anthony was mentioning. So first of all, you have OPEC. OPEC, decided this weekend to extend their production cuts for another 3 months, and then consider increasing production. So what's amazing about oil to me is it peaked about 2.5 years ago at over $100 a barrel. Since then, you still have Russia and Ukraine fighting. You still have traffic through the Suez Canal and the Red Sea down by 80% after the Israel-Hamas war began, and the Houthi rebels in Yemen became involved, and slowed down that traffic. And you have OPEC having taken 3.5 million barrels of oil off the market per day, about 3.5% of global production. You still have oil, it's trading around $70 a barrel. So this is a very depressed market. So why? Part of it is because of slow growth in China. China is the world's biggest importer of oil. Over the last few decades, China went from using 5 million to using 15 million barrels per day, of which about 10 million is imported into China. You have to remember that the green energy transition is more than just the United States. China, in some ways, is the leader of this transition. Last year, 35% of new cars in China were EVs. This year, that's over 50%. In addition to that, you have this sort of global trend, long-term global trend, even for combustion engines to become more and more efficient. So the average car on the road using a combustion engine uses 2% less fuel this year than it did the year before. So just to keep demand stable, we all have to drive 2% more per year. And the thing is that, comparing 2024 to 2019 globally, we're not driving any more than we did 5 years ago. So the average car over the last 5 years has become 10% more efficient, and we're not driving any further. So demand has actually dropped. And so if OPEC increases production in March, you could be looking at a crash in the price of oil. I'm not saying that's going to happen, but it's a real possibility. There are upside risks, like if Israel bombs the Iranian oil fields or oil export terminals, you could see a lot of upside as well. But it looks like that conflict between Israel and various Iranian proxies is starting to simmer down. We don't know the course of it, of course, but I think there's a strong preference on the part of the incoming administration to see an end to that conflict before they take power on the 20th of January. All of that could be very bearish for the price of oil. And then lastly, of course, the incoming administration would like to increase domestic production of oil. The current administration limited fracking on public lands. Only about 10% of oil is produced on public lands, around 90% on private lands. So despite those restrictions, we're actually at record U.S. energy production right now. But the incoming administration might like to increase that further. I don't think they can necessarily cause that to happen, but they can free up some extra production space that could at least keep a cap on oil. So there's a lot of things going on in oil, but I would say kind of in general, they look more bearish to me than bullish.
Awesome. That's a great summary. Thank you for sharing that, Erik. Just a reminder to everybody, please do drop your questions in the chat. We'll start working our way through the remaining ones very soon. But Anthony, Erik, I guess, we've touched on stocks, we've touched on bonds, commodities as well, a little. I want to spend some time on alternatives because, in that mix, there's been a lot more attention over the last couple of years on alternatives, on derivatives for one, on private credit for another. And I'd love to get your take, Anthony, maybe starting with you on, how that mix impacts your thoughts on asset allocation when you do come to approach trading.
Small. I've tried to really believe in the future of what Bitcoin and all these cryptos can do, and its immediacy impact on society. And it's like you see it, and I'm not somebody who's an expert on the crypto space whatsoever, but I continue to look at it and say, it's a market that's just trading price. It's not necessarily a use case yet. I think in the future it absolutely is. So I just find it very difficult to see any major investment in it unless you're looking out and saying, you know what, I just have a small percentage of it, because it moves also so much percentage wise that it's like I can never allocate a lot of my capital to it because I want to sleep at night. It's like as much as Bitcoin's gone up, it could go down in a blink, and you wake up and it could be down 15, 20%. And everyone's like, yeah, don't worry about it. It's no big deal. Well, yeah, I mean, it's easy for you to say, so I think riding the waves in it is just so difficult. And so it's just one of those things where I just look at it and go, be small with it. And that's it. I don't really have any foresight as to how it will move, because it's, I look at Bitcoin and these other cryptos, and when they're moving higher, it's all momentum in, it's all momentum out. And so it's like, you want to buy XRP on a 150% rally or whatever it is, or Bitcoin. And it's like, I don't trade that way. So it's difficult for me to look at those as like, oh yeah, there's edge or opportunity there. To me, it's small in the long-term fund, and, ride the wave, but with a small amount.
Look, I'd say that's refreshingly honest. I think if you'd started to say, hey, I know exactly what's going to happen. These are the cryptos I'm buying. These are the ones I'm not. I'd probably smile and nod, but inside be screaming liar. But look, refreshingly honest. Erik, earlier you mentioned, you talked about, almost the trickle-down effect of economics. So whether government spending or other spending, it goes into someone's pocket and then they either spend or invest. Is there any impact that you're sort of keeping an eye on in terms of, the rise of alternatives, be it private credit, be it crypto, as we've touched on? Do you expect that to have any real-world implications as you look to the macro?
So I don't really see crypto as having a lot of macroeconomic implications in the sense that if Bitcoin goes up or down, I don't think it really affects GDP very much. I mean, it may have some imperceptible effect, of course, but these markets are still relatively small. I mean, the total market cap of Bitcoin and the other crypto assets is a couple $1 trillion, which I know sounds like a ton of money. You compare that to the market cap of, say, the U.S. equity market or the value of the world's outstanding gold, and it's actually really quite small. I mean, the U.S. stock market has a market cap of something like $50 trillion or something like that, or it's maybe $55 trillion just in the U.S. equity market alone. So I don't think it has a big macro impact. I completely agree with what Anthony said. I look at the risk of investing in Bitcoin measured by the annualized standard deviation of its daily moves, and it is roughly 4 times as volatile as the S&P 500 or gold. So to me, that means that if you do trade it, the sizing should probably be roughly 1/4 what you're doing in some of these other assets. So I think that's how I would tend to view it. I do think Bitcoin has sort of an analogy to gold, however, in the sense that it is a potential inflation hedge because central banks can't print it. Central banks can't create gold, they can't create silver, and they can't create cryptocurrencies. With Bitcoin, there will only ever be 21 million coins, of which maybe 19.5 million already exist. And the pace of production of those coins slowed in April from 330,000 a year to 165,000 per year. So this new supply is becoming more scarce. And I think that may have played a role in Bitcoin's recent rise in price.
Super interesting. Thank you for sharing that. Okay, we've got a couple of minutes left, so I want to rattle through as many of the leftover questions as possible. DS asks, and maybe I'll come to you on this one, Erik. How do tariffs affect inflation?
Yeah, so tariffs cause inflation. Tariffs are essentially a tax on consumers. So we've heard so many different proposals for tariffs, but one of them is a 10% tariff on all goods coming into the United States. So currently imports into the United States are 12% of GDP. If you put a 10% tax on that, that 12% will probably decline a bit. So let's say it goes down to 11% of GDP. That brings in 1.1% of GDP, or 10% of 11% of GDP worth of tax revenue. And a common estimate among economists is that roughly 70% or 80% of those costs get passed on to consumers. So if we were to have a 10% tariff on all goods coming into the US, which is just one of a blizzard of different proposals that we've heard out of the incoming administration, that would, by my estimate, add about 0.7% to inflation. Core inflation is currently 3.3%, might push it up towards 4%.
Got you. That is a great explanation. And Anthony, maybe very quickly coming to you, possibly the $1 million question. Where are there untapped areas to be looking at for 2025? I know you've mentioned a couple around the Russell, depending on what happens on the macro picture. But outside of AI, what are we missing?
I'm focused on where I see somewhat of an edge or where maybe people are caught off sides. I mean, I think that anytime you're looking for opportunity, you have to look where either you think people are caught off sides or there could be a massive shift, right? There could be a change in current policy or just macro environment, or you look for an area that's just been totally beaten down to the point where the risk just becomes pretty small and there's opportunity there. I mean, when I look at last year, I mean, so many things rose that it's hard for me to see anything that, is jumping out at me. I think the one thing that I look at is debt is probably the biggest fear I have going forward as to what happens from that, and so I continue to think that the bond market is the place to look for. I think the bond market's going to be volatile next year. I think between are rates going to, how much are they going to go down? What's happening with inflation? What's happening with debt? I think the long end of the curve, I continue to think, is probably mispriced in terms of if you have the viewpoint that inflation will remain hot and debt is going to be an issue. I think that the long end most likely continues to drift lower, even in a rate cutting environment, and rate cutting can be 1 or 2 rates. So I think that that's where I see it. I mean, short to long end of the curve is probably where it's mispriced.
And on that bombshell, that is all we have time for this session. Anthony, Erik, thank you so much for sharing your insights, and thank you to Jacob, even though we lost you, unfortunately, pretty early on. Super valuable insight. Thank you to everybody who joined us for this session. We hope you've got some valuable, actionable takeaways for your 2025 investing, planning, and trading. Stick around. We'll be diving deeper in the next session. It starts in 15 minutes, so stay tuned. See you all there, and thanks again. Have a great day.